Okay, so let's get started. So, hi Ludovic, welcome to Private Equity Confidential, and thanks for agreeing to speak a few words to my students at the American University in Cairo Private Equity course. And perhaps we could start with you saying a few words about yourself and how you came into private equity and what exciting things you're doing right now.
I came to it by by mistake or by luck. I don't know. A long time ago, when I was doing my PhD studies, looking for topics. So now I've been doing research in private equity and teaching it for 20 years. I'm a French national, and I'm currently a professor at Oxford University, and I teach about 500 students a year in different private equity courses and try to do a lot of research on it.
Okay, thanks. And have you had much interaction with the students from emerging markets countries who might be going back, either going to Oxford and going back to their homeland to become PE managers in their emerging markets?
Yeah, actually, in one of my recent podcasts, I interviewed a student of mine who's from South Africa, but he's in Dubai doing private equity. And so he was explaining the landscape in the Middle East. And in particular, actually, he covered Egypt in his presentation because his firm has quite some investment in Egypt. A fun fact that maybe you don't know is that Oxford University is probably one of the only top business school that has a very high contingency of students from the African continent. So we have 15% of our students who are from the African continent. And so that's by far the highest number of any top business school. So we do have people, maybe not so much from Egypt. We have some, but not too many. It's mainly people from Nigeria, Kenya, and South Africa. That's overweighted, clearly, but we have students from other places on the African continent. And so yeah, some of them go back to invest in private equity. We have a close relationship with CDC, and so a lot of our alumni are at CDC, Oreos, so then back to CDC. So that's the DFI from the UK. And from my days in the Netherlands, I have a lot of ex-students at FMO, the Dutch DFI. So yeah, I have most of my ex-students are probably working in emerging market private equity, actually.
Okay, well, that's very interesting. So, Ludovic, let's turn to the subject of your famous 2020 paper, in which you discuss returns on private equity, particularly from the perspective of the large LBO funds. And this paper is one of the compulsory required readings for all my students. So this is a fantastic opportunity for them to hear directly from the author about what this paper is about. So maybe you could just say in a few words what your paper was about, what pushed you to research it, to publish it, and what you think, what kind of impact you think it has made on the market.
It's a very simple question, and it's a classic economist type of question, which is, here is an industry. We just want to know how much money was given to them, how much money they gave back, and how much did they charge for it. That's it. That's the question. And that happens to be a very controversial question to ask, I guess. Well, the answer can be controversial, I guess. I don't know. I'm still puzzled by the controversy. And so this question was asked for the US because we know we have enough data really only for the US. We don't know enough for emerging markets or even Europe. And so in the US, what it showed is that the amount of money that was given back compared to given to the private equity industry on aggregate, and so therefore, indeed, it's mainly the large funds because it's the sum of all the money, right? So, so that it depends a lot on the benchmark. So if you take a benchmark that seems to be quite appropriate, it has always been the case that they return about as much as what they have taken. If you take into account that there is a growth of public equity markets that is happening as well. So in other words, they don't give back more than what the stock market would have given you back. Okay, so that's so and it has always been like that if you take an appropriate benchmark. Now, people have never wanted to use an appropriate benchmark. So in the old days, they were insisting on the S&P 500, which back then was the worst performing index out there. And I had emphasized that, but people decided to ignore it. But after 2007, the S&P 500 started to do very well. And so then now, when the people are saying, oh no, let's not use the S&P anymore, let's use MSCI World as a benchmark, and which is weird, like for US private equity, why would you use the MSCI World as a benchmark? And the MSCI World turns out to be underperforming the S&P 500 by quite a bit. And so then against MSCI World, private equity looks good, American private equity once again. So, but if you use the S&P 500 or any US stock index, then they just returned as much as the stock market would have had. But for the privilege, they have charged a massive amount of carried interest and other fees. And we are talking about numbers that are like staggering. We are talking about thousands of individuals splitting $500 billion type of numbers. So this is like extraordinary. And so I guess that's what made people a bit upset and uncomfortable. So people are always uncomfortable when you talk about the very high pay in the industry. You know, the best paid finance professionals work in private equity. The richest people work in private equity. You know, if you go to Oxford and you go to a more expensive area of Oxford, my colleague Tim Jenkinson, who actually works in private equity as an academic, he said, you know, I'm the last academic to have bought a house in my street, and that was 25 years ago. Who has bought houses in his fancy street over the last 25 years? First, it was mainly investment bankers, and now it's a bit investment bankers and private equity professionals. We have the only people who buy houses in that expensive street. And when you tell people, well, you know, not only you're making obscene amounts of money, but it doesn't look like you have really earned it in a sense, then they get really, really upset. And so that's why it created a lot of upset people, I guess, and waves. If we go to then emerging markets, again, we don't have a picture for emerging markets. The broad consensus is that emerging markets haven't done very well in terms of performance. The broad consensus is that, like, especially Africa hasn't done very well. Latin America is littered with problems. Lots of money went into Brazil at one point in time, didn't do well. All these BRICS didn't do well. And I talk about that in the book. And I actually gave a big talk once at IFC conference, which is like the biggest conference for emerging market private equity. And people were very surprised because I'm usually not very upbeat about private equity returns. But then the way I had spin that conversation was actually people are very unfair to private equity returns in emerging markets. And the reason that they are very unfair, it's a bit the same for like mid-market in general, but particularly for emerging markets and particularly for Africa, is that people, first of all, they look at dollar returns. And dollar appreciated against most African currencies. And so people say, look, the returns are crap. Say, well, they're not responsible for the US dollar having appreciated over that time period. So all the emerging markets are looking bad in US dollars, but that's just a currency effect. The other big element is that private equity firms, especially larger ones, and in particular in the US and a bit in the UK, have access to all kinds of tools to pump up their numbers. They can, of course, there's the usual ones of like pumping up their NAVs or things like that. But they have access to subscription lines of credits, all kinds of things like that. They can do some quick flips with some early investments and so on, which means that their IRR, which is the main measure that is used by the industry, unfortunately, is extremely high. And so when people look at, like a private equity Africa standard fund, they will see returns like 10%. But that 10% is real. It's really 10%. And it's actually pretty good to have 10% returns. But the private equity guys in the US and in the UK, they all have 30% returns because they pump it up by using various tricks that are not available in Africa and the like. And so then a lot of people are saying, like, why would I invest in private equity Africa to get like 10? It doesn't sound exciting. And then when I can get 30 in the US, well, the answer is you never got 30 in the US. That never happened. You have got 10 in the US if you measure it properly. And it's just as much as Africa. And Africa gives you diversification benefits that are not as obvious in the US. So people are not that fair with emerging market private equity. And I often emphasize that to a surprise of many. Now, we should not forget the elephant in the room. There is a big book that is coming out on arbitrage that has shown how, you can also make things up in emerging markets. Now, arbitrage would have happened the same way if it was not in emerging markets. The tricks that arbitrage was using are available to absolutely everyone, and there is nothing specific to the emerging markets that means that arbitrage could only exist because the arbitrage scandal could only exist because they were in Dubai. They could have been located in New York. That guy would have done the exact same thing, and he wouldn't have got caught if he wouldn't have been for a very perseverant person at the Gates Foundation. So there is nothing specific to emerging markets that is attached to the arbitrage scandal. And paradoxically, in emerging markets, because people are scared, like they say, I cannot trust any number, I cannot trust the accounting, I cannot trust any contract, and so on. When you compare limited partnership agreements of an emerging market fund compared to an American fund, I'm more scared with the American one, because people are just, they say it's the US, there's no problem, I don't need to double check anything, any footnote is fine. And people tell you, oh, look, they're all written this way in the US. That's it. It's like market practice is the magic word. And when you look at contracts in emerging markets, they are much tighter. And the rules around NAVs and so on are much tighter because people are scared. So paradoxically, you're almost in a safer position in emerging markets in terms of corporate governance than you are with the US. That said, we should not be naive. Private equity in emerging markets is extremely difficult, more so than in the US. And so indeed, the returns haven't been spectacular in compared to the growth rates of these countries, but it hasn't been bad, but it hasn't been spectacular.
Yeah, I think you make some good points. I think particularly, the fact of the emerging markets is, on the one hand, you may have a lot of potential, particularly in the mid-market, but you do have a much tougher environmental factors that work against you. But certainly, emerging markets seem to have occupied about 20% of the market, and they're not going anywhere. And they seem to be growing. My experience has been that it tends to be one step forward, two steps back. So Turkey has a couple of good years, and they go backwards. Egypt has a good period. I mean, right now it looks like Egypt, following the devaluation of 2016 and the reset in government, seems to be on a good trajectory for the next few years. So I'm quite optimistic. I don't know what your perspective is on the different, emerging markets. It's a bit of a mosaic, isn't it?
It's reasonable what you just said. I would tend to agree. We need to be mindful of one more thing that I often emphasize, is that when a country is hot or seen as an opportunity, prices go up in that country, right? So the problem is, when people were making the Brazil case in 2007, the fundamentals were strong, right? Everything was looking very, very good. But then you started seeing transactions that were just like, the prices didn't make any sense. And because there was so much money flowing in. And so it's not going to end up well, right? It's like, people say, well, China is growing fast. Sure, but it's super expensive. So, and if you look at the returns of a Chinese stock market, they're not that high. And because these companies are super expensive, and surely China is fascinating, the growth rate, everything, there's a lot to say. But that doesn't mean you're going to make money, because it all depends on the price you pay for these businesses. So when you're in a place like maybe you just mentioned Egypt, where a number of people are pretty cold about it because they typically look at past returns, right? And a lot of people have this mechanical, approach. Like, they look at past returns, the recent returns were not good, so they're not too hot about it. But that's maybe the exact niche where to exploit these mistakes that many people make, by finding a place where the recent past is not looking too good, but they have fixed things so that they're looking forward, it's looking nice. Now, you never know the future, it may not pan out well, but you're in the best position possible. And so if indeed it is the case that, Egypt has had recent bad performance, but has now fixed many things, and looking forward seems better, then that's exactly the sorts of geography one should pay close attention to. And that's certainly how people can then pitch their funds, because if you are educating Egyptian people working in private equity, the biggest challenge is to convince people, usually outside of Egypt, that they should invest there. And so to get that pitch right is essential.
Yes, I think the timing is important. I think Perhaps I'd qualify what you said as saying that the game here is to convince people outside of Egypt that it's not the time to invest and keep prices down, and then in 4 or 5 years, then it's the time to invest and we get our exits. Yes, of course. Yes, I think I'm heartened by the fact that most Egyptian fund managers who are not homegrown tend to have a European background, and it looks to me like European mid-cap fund managers culturally tend to dislike going into bidding games. It seems to be more of an American mentality. So I'm reasonably hopeful that fund managers will tend to just walk away rather than bid against each other, which will be better for the market, certainly in the mid-cap space.
I mean, we have seen bidding wars in Poland, for example, in Europe, when Poland was suddenly hot and everybody went there and started like fighting one another. I don't expect this to happen in Egypt, so that's for sure. I think the main challenge is, so the price is yes, but probably the main challenge in the specific situation of Egypt is more that you have a guarantee that you'll be able to take your money out. What is going to happen to the currency? You're going to get, well, in which currency do you get your revenues in, and so on. So these are the main challenges, right? That, like, you know, you will be able to keep control of your assets, and nobody's going to come and size your assets, and so on and so forth. So these are the main challenges. And, you know, it sounds trivial, but like we have tons of examples where people, you know, even like China, right? The recent 3 billion fine on one guy, like, you know, it's totally arbitrary, right? So you say, okay, Jack Ma, you kind of talked very loud. Here you are, 3 billion fine for anti-competitive behavior, like whatever. And so there are many countries like this, right? And to a certain extent also, you know, we could say that even Western countries would do this sort of thing. So so that's the main thing to be nervous about, right? When you do your investments, to be really sure that you'll be able to get your money out, that the currency will be okay, and so on and so forth.
Okay, very interesting. Well, let's maybe change tack and let's talk about your book. I'm planning to make your book one of the required readings for the students at the course at the American University in Cairo, and so it'd be interesting for you to say a few words about it. There's a second edition that came out, I think, which is the one that's gone from a red to a blue cover, if I remember correctly. This is the last edition, and I think one of the differences in the second edition is you've come on to the question of ESG, impact investment, and these other topics. So what's different in your second edition compared to the first? How has it evolved?
Yeah, so it has doubled in size. Unfortunately, I always wanted to keep it tight, but it has doubled in size because I wanted to introduce emerging markets. I wanted to introduce impact, ESG considerations and discussions. I wanted to introduce some case studies. I have a new one on that happens in the Bronx in New York. That is an example of doing impact correctly. And then there's a huge dictionary also at the end, which is supposed also to be a bit fun so that people want to look at the technical definitions. It's a language private equity. You can know right away if somebody's fluent or not. And so it's very important that people come across as fluent. So there is this massive dictionary that has been integrated that is also contributing to the expansion. So it still is mainly tilted towards LBOs. It is still tilted towards US, UK, because we're talking about LBOs, but LBOs are coming in the rest of the world. And the book is, you know, also relevant for things that are not LBOs, but are broadly private equity. But so, yeah, and the book is supposed to be easy-ish to read, and fun enough so that people want to read it. And so that has been the leitmotiv.
Okay, and let's go finally. If you're thinking that, let's say you've come to give a talk to my students at American University in Cairo doing this private equity course, what advice could you give them on how to develop a career in private equity? What words of advice could you give them?
So that is the most frequently asked question that I get in Oxford. 500 people a year ask that question. So it's a pretty classic one. So I have an answer. The number one answer I give is, do not think that there is only one kind of job in private equity, which is working for a private equity firm investing in portfolio companies. Most students think that. They all want to be at KKR buying a company. and managing it. This is very unlikely to happen. If you get into KKR, you probably do a lot of spreadsheet and PowerPoint slides until late at night for many, many, many years. And that's not the only jobs that are interesting in private equity, provided that Excel spreadsheets and PowerPoints are interesting. You have more and more things, like I just did a podcast today on investor relations. All the type of functions in the private equity funds that are interesting, large, legal, compliance, and so on and so forth, accounting. There are lots of very interesting jobs in that space. There is also a lot of jobs in smaller funds and structures where you are closer to the investments. So often people think of like, the dream is to go to KKR, but then they do spreadsheet for 10 years. If they go for a small private equity fund, they will be involved directly with investments pretty quickly. So and people tend to dismiss that. So they should not dismiss small funds. It can be a much more interesting job. And they should think about all the para-private equity structures as well. So again, nowadays, you would send your CV to, I don't know, let's say Hamilton Lane, which was originally a consultant. But now they manage their own funds. They have all kinds of direct investments in companies and the like. And people may not immediately think of this kind of company to apply to, like a Canadian pension fund. People think that's boring. I don't want to work for a pension fund. Well, they do a lot of deals that are very interesting. And again, very early on from a career perspective, you may be close to a deal, while in a KKR, you wouldn't get so close so quickly. So you have all kinds of things like feeder funds. You have funds that have reinvented themselves. You have all kinds of family offices doing direct investments and the like. So there are tons of very interesting jobs in private equity. And most people don't think about these jobs. They think about the Blackstone and KKR of this world. And maybe paradoxically, if they get into it, it might not be the most exciting job because they will be doing a lot of Excel spreadsheet and PowerPoint before they get in front of a deal. Yeah. So that's my main advice, to be aware of a landscape of private markets in order to have a good view of all the jobs that can exist that are exciting, and take a job that fits them. Not everybody should run a company, and not in any industry. And so that's why in the book as well, I insist a lot on this landscape view. There is one chapter entirely dedicated to the different asset owners, the different actors, trying to give an idea about who does what kind of jobs are out there, for people to have this view of a landscape. I call it the Wonderland landscape. And so that to me is important. And then on jobs specifically, I have a podcast also about how to game a job interview. Most people fail on the same sorts of things. So now that I've told people how to game it, now nobody's going to fail anymore. So they will have to find another way to select people. But the key thing on this is what we could call common sense and rigorous thinking. And that sounds trivial, but most people do not exhibit that. And an example happened actually last week, and I think it was even like for an emerging market private equity fund. So a student of mine who went through, I think it was through my online executive education course, a student of mine goes to a job interview. This person just transitioned. She didn't know private equity before. She took this course. It's just 6 weeks online course. And she comes out of a course. So, she knows more after 6 weeks, but, she had never done private equity before. And she decides to show up at a job interview for an investment position, which is like the most coveted positions. And she's given a case, which is the LBO of Nike in the US. So they say, here is Nike. These are all the data about Nike. It's publicly traded company. So here's all the accounts, etc. We want to do an LBO of Nike. And we would like you to work on the model, how we would finance this, who would provide the debt, and like what would be the exit route. Like we want you to write the pitch book for the Nike LBO. All the people being interviewed started right away putting a term loan A here, a term loan B there, to put like a mezzanine debt here, and to work out, the IRR and so on. And she just stopped in front of that and then turned to the guy and said, but Nike is too big for an LBO. There is no one has a fund that is large enough to put like the equity into this deal. You could have co-investors like pension funds and the like, but they wouldn't be able to put that kind of money, and nobody can lend you that. Even Ares, the largest private debt fund, cannot lend you this kind of amount. They go to 1 or 2 billion, but not more. So that's just not possible. Are you sure? And she was just thinking like, she hasn't understood the question. She was not even like trying to be smart. She was just like, taking this very rationally. Again, and I think my course really made her think that way, because what we try to give is, here is the landscape. Here is the largest fund ever. Here's the largest transaction ever. Here is how much, who lends what, how much, for what reason, and so on. And so when she was really in that mindset that like, look, this is not feasible. And people said, okay, well done. Can you come back next week? And she was very surprised. She was like, what do you mean? I said, well, but we love the way you're thinking. And everyone else was there, on the Excel spreadsheet, going like completely wild, putting in some numbers and expectations and whatever. So that's the other thing I try to tell people. What they need to acquire is rigorous way of thinking, very good knowledge of industry, the language, the techniques, etc., and bring a huge amount of common sense and analytical thinking. And that is actually a very rare commodity. Most people are very mechanical. They want to learn the recipe and come to a course and say, tell me the recipe to do a deal.
Okay, let's go with the last question, which is a very topical question, a bit controversial. It's about diversity in private equity. I think along with the talk about ESG, that's sort of led to more talk about diversity, which is clearly gender and secondarily perhaps ethnic diversity. So what are your thoughts on diversity? Is it coming? Is it a good thing that it's talked about? Should there be quotas? Should there be mandatory unconscious bias training? Where should it go in private equity, in your view?
I like the training. I think the training is important. I come from, so it's not obvious because I'm a white male and I check all the boxes, but within my country I would have been classified as subpar. So but in an English environment I look very much in the right camp. And I think that people do not realize what it is to not be part of the mainstream, or to be like the white privilege or things like that. And training can help. Quotas probably not, but it could be a temporary measure. But it's not. I believe, but it's because I'm a teacher as well. I believe in training and in explaining to people. And so I believe in people to be vocal about things. I believe in people explaining why there is a white privilege, and so it's an effort of it's about education. We just don't realize these things. So even though I'm conscious about a number of things, I'm working on a number of committees on diversity at Oxford University. We take this question extremely seriously. And, I was discussing with some students at my college, and they said, whenever I go to a college dinner, so this person was a woman and she wears a veil. She said, everyone goes through the door at the entrance of a college to dinner, and I'm always stopped and I'm asked for my student card. Say, how humiliating is that? I'm going with a group of 10 people, like all 9 of them, they all go through, and then they stop me and say, do you have your student card? And it's like each time. Like and that, you may say, well, that's a detail that doesn't prevent this person from succeeding in her studies. Sure, but like it happens every day. It does affect how you feel and how you think and how relaxed you are and so on and so forth. And that's just one minor example of a microaggression, but there are lots like this. And so, and it's a bit the same with women. Men makes a number of jokes, behave in a certain way, etc. And then, some women don't feel very comfortable in that environment and therefore don't apply to certain jobs and don't want to be in certain type of positions because they don't want to face this. I've had tons of students of mine who are amazing women who have got amazing jobs. And then very often, when people walk in a meeting with them, they say whether they can help them with a cup of coffee and say, no, I'm actually the private equity partner you're supposed to meet, and I'm here to invest in your company. But so a lot of people say, I don't want to put up with that. Okay, I'm going to take a different job. And we see these clusters. You see that in private equity, for example, if you go to a session that is private equity, impact investing, ESG, and so on, half of the room will be women, if not more. If you go to a session on large cap buyout, there are 2 women out of 100. And the atmosphere, the way people speak, the way they think, the way they act is a very alpha male style. And so we need to be conscious that we make it difficult for some people to feel at ease. And so diversity is not just even gender, ethnic, and so on, but it can be also a handicap. It can be someone who has, I don't know the word in English, but like people that zozote, for example, like things like the teetering, I think they say in English. Yeah. So, it can be that. It can be people who do not see very well. It can be people that are a bit deaf, etc., that are too short, too tall, whatever. And it's really this notion of inclusivity and being mindful of people that are different and how they feel when we make certain jokes, behave in a certain way, and so on. And this is like super important. And the fact that like we woke up to that over the last 10 years, and we still have a long way to go, but we woke up to it, I think is a very good thing. And I think it's just by repeating it again and again and again. It's about education. Only that can save us. Quotas we can do, but that's tricky because people always question whether you're here because of a quota. To give you an example, in the French elite school, which I didn't do because again, from my background, it would have been impossible. People say, should we have a quota so that we have people like Ludo making it to a top French school, so-called elite school in France? And my answer is, no, you don't need a quota to have me in your school. Because I will pass the exam if you ask the right questions. If the questions at the exam are about, tell us about the painters of the Middle Ages and write an eloquent essay about that, I'm going to fail that exam. But if you ask me questions about things that are more like, relevant to rural France type of people, or that are about more reasoning or more math or more things like that, then I'm going to have a chance. But if you ask elite type of question or questions that only people who grew up in a very large city with access to museums and the like can answer, then guess who you're going to hire? You're going to hire only people like this. Yeah. So that's why I don't think the quota helps. I don't need a quota to get in an elite French school. What I need is that the questions are not dedicated or targeted towards people that do not look like me.
Yeah. So, equality of opportunity rather than equality of outcome, in a sense. Yes, absolutely. Okay, great. Well, I think we've covered plenty of interesting stuff. So thanks a lot, Ludo, for everything. I'm sure it's going to go down really well with everybody. So hopefully I can get you to come out to Egypt sometime, budget permitting, if you're interested. Hopefully I could swing it. If you're interested, I'll try and do that.
Now, in the past, I used to try to avoid traveling because it was taking a lot of time, but now I'm so desperate to go anywhere.
Yeah, and you've got an excuse for Cairo. They've got this amazing new museum they've built where they've moved the pharaohs recently. You might have seen something on TV about that. That's worth a trip just on itself. So let's think about that for maybe 2022.
My wife has actually lived in Cairo for many years.
Oh, okay. So
I even have a link to her.
Okay. Well, thanks a lot for your time once again. I'll share some of the video with you and hope to meet you in person.
Yeah,
thanks a lot.